Hello everyone. Let's make sure we're streaming correctly to start with. Yeah, looks like we are. All right, we're live. The green screen behind me is not the best, so apologies for this. But I thought it'd be best to just have it as opposed to last time when it was just normal background. All right, let's get started, shall we? So I was a bit afraid about today's coding session because I thought there wouldn't be much to say. I worked a little bit on the code in between now and when we last left off, and there was very few things to talk about. But I realized as I went through Refinitiv Workspace, that there is a way to check what we've done, and I've never used this tool before, so I thought it'd be great to actually go through it together. It seems like we have this BNDC app, this bond calculator app, and I'd like to take advantage of it. And that's where I was at. That's where I was at, trying to figure out what this does. So here, for example, if I show you where we were at in the code, we managed to get all of the kind of data that we were looking for up to the yield to maturity implied by a specific price. We already went through all of this, and we've got a cash flow, which I've just decided to add, as it turns out, for no particularly good reason, but it is always quite good, and it's a way to check your code as well, check your workflow in the background to get your cash flow. So here's a cash flow question. I think there's a bit of a copying going on here. Yeah, that's it. I was working on this and then I forgot to delete this. So let's just comment it out for now and move forward. All right, we've got a yield to maturity. There you go. And this is the yield to maturity implied that we find right here. And it's implied by a specific date, and the date in question is the one that we are after. So, which is to say here, the 31st of July, 2020. Because remember, we're putting ourselves in the shoes of this investor on that date at the end of July, 2020. By the way, since we're here, since we can see the code and everything, I will post this code. So this is the 21st version. As you know, I name all of my versions with a number at the end. So let's save this, and I'm going to put it for you on GitHub. Let me do that right now. Let's go on GitHub. I'm going to leave it at the same place as last time. So it was in the 0 coupon bond, risk-free rates and excess returns. Oh, I've made one for coupon paying. There you go. Oh, that's brilliant. Oh, cool. I'll just show you this. So there you go. Here, there is one on Refinitiv API samples, article.datastream.python, and then computing this one here, computing risk-free rates and excess returns from coupon-paying bonds, bootstrapping. And so I've made this new one. So I've put the 15th one, which is where we left off on the last video. And now let's have a look at the new one. So I'm going to put it in here. Boom. Add new file, add file. I think I can just drag it, I'm pretty sure. Let me find it in my PC. So what are we doing here? We're doing the coupon paying bond article. There you go. Boom, easy peasy. So he says, no. I don't need to put any comments. There you go. Maybe I was just too quick. Didn't let it load. Seems like it. There you go. So here is the code at the start of our session today. And from now on, what I'm going to do is I'm going to name it 22. So this is 21. And from now on, everything we're going to do is going to be the discrepancy between 21 and 22, which I'll upload at the end of this stream. All right, so you can find it here on the link I've just told you about. And what we've done here is that, as I said, we've got the yield to maturity implied by a specific date, this date being this just arbitrary date whereby we're just putting ourselves in the shoes of this investor. And specifically here, I decided just for arbitrary sake to check just one of the bonds we've got. Which one? Which bond is it? I forgot now. Email somewhere. Yes, I found it. Give me 1 second so I can find it. Here it is. All right, so up. This is the, as you know from last stream, the DSWS navigator, the Datastream navigator. So let's just have a look. Oh, I already had it. There you go. That was it. And this is the written question. So all I have to do, I'll show you how to get all the way to this bond calculator from the start, just because it can be a bit daunting and not knowing where to go. So this is the written question. You know, we were using the navigator before, and now from the RIC, I can just go in there and type bond cal. There you go. It's the BNDC that we're looking for, this one. So if I just click on that, it's going to send me to the same page we were at just now. There you go. Perfect. And we're looking, it's just loading. There you go. And we're looking at this specific bond with fixed coupon. Let me check with the Datastream navigator. What have we got here? What does the navigator tell us? The navigator tells us that we have a coupon of 2.625. Yeah, 2.625. Yeah, pretty bang on. So now that we've got all this, let me just put it all together. There's no need to have so many windows everywhere. We can check what we've done. So here, for example, we're looking at yield to maturity, which is just a simple yield to maturity from the price at issue and the price and the date at maturity. So we're calculating just a simple yield to maturity as per. Let me just scroll back up to the equation. So we're not calculating the spot rate here. We're simply calculating the yield to maturity, if I can find it. Oh yes, I added a lot of comments in there just for completion's sake, and I wanted to do this out of the stream because it tends to be the more boring bit of the of coding in general. There you go. So this is the equation in general, and the yield to maturity that we found down on our data set is this specific yield to maturity there from this equation. Let me maybe zoom in for you if I can find a presentation mode. There we go. That should help us. And there you go. This is our equation in question. This is our yield to maturity. I'm looking at the coupon paying. Actually, they're all coupon paying here, but specifically this top bit, because our maturity tends to be more than half a year, or equal to. All right, so let's scroll back down to where we were. Here it is, and we were looking at this specific code. So I can't really tell which ones. I think it's this one, but just in case, let's just do this, and there, that was right. Okay, so this is a 5 years. It's not telling me in here. It's giving me a special yield, but obviously these are all as per these settlements. So settlement date is actually not on that day, is it? It is on last 2023, 12/31. But if I remember correctly, it's not going to let me do this. So 2023, 12, so the 31st of December, 2023, August, September, October, December, 31st. And the reason why it might not allow me is either because it is the redemption day, yep, or because it's a non-trading day. Yeah, it's always a non-trading day. Although this one will be a non-trading day as well, Saturday. And yeah, it allows me. It's just okay with it for some reason. But I'm more interested in yields. And according to what we're doing here, we are keeping up with the actual day when it was issued. So let's have a look at that then. Let's go in there. It is issued 2018, 12/31. All right, 2020, 2018. Oh, quite a while back. I wonder if I can just, yeah, I can. December 31st, 2018. Let's go to the calculation. I hope that it's okay with me just writing it freehand. Maybe now I'll be able to go for the 31st. Let's test this. Oh, all right. It's being capricious. All right, so we've got a clean price. It's in percentage terms, though. I did choose for close because that's what Datastream will give us. So we don't have much of a choice. That's the right one. Yes. It's giving us a ridiculous yield. What I'm going to have to do is check how this app works outside this stream, and then verify what we've done this far. Because, for example, if we look at this, let's put it in line with our code. It's being very slow. There we go. Where were we? With our code. Here. So if we have a look at what we've got here, I think that this was our yield to maturity, wasn't it? Yes, it was. Yeah, here. So our yield to maturity here. Oh no, it's not that far actually. Oh no, it is. Yes, of course. That'd be very silly. 108. 0.025, which is obviously very different from anything we're seeing here. 0.025. Unless we're looking at, okay, let's do a quick sanity check with the calculator. What are we looking at here? I'm looking at my 0.025, so it's what's 1, 2, 4, 2, 3, so we've got 3/8. Let's remove, because it's in percentage. Yeah, let's try that. What have we got here? 25.096. 25.0. No, it'll be 25.0. Yep, 96. Just do a sanity check. And would that be the price by any chance? No, no, not at all. I was just wondering if there was an inversion somewhere from either 100 or literally 1 over, but no. All right, that's what I'm going to do. I'm going to check out this app outside this stream and get back for sanity's check, probably in the next stream. I thought this would be the last one, specifically for coupon paying rates, but let's do that instead. Let's finish what we've got here, and then let's do this check that I was just starting just now. All right, next time. I might do more than one a week actually, because otherwise going through the code a bit too slowly. So I'll have a look and schedule it in to Twitch. So do keep an eye out for this, and then I'll publish it on YouTube straight after it's done as well. All right. So where were we? We were, have a very quick recap, looking at coupon paying bonds and looking to bootstrapping and spot rates. And if I scroll down, then we looked at which kinds of bonds paid coupons, and I chose the US case just because it is the most common, because this is the world's reserve currency. And then we looked at the yield to maturity and how it is calculated as according to the usual calculation. And we saw that we can't just have an equation for it, we have to compute it, unfortunately. But that is why we're here, that is why we're using Python and Datastream to connect the data that we're looking for. So here, for example, we had our price, that was beautiful. We had our fixed data, looking at our issue date, term, all the way to which exchanges you could use to get these. We looked at the difference between secondary and primary markets, so that's why we're looking here at prices that you can actually get, as opposed to the yields provided by, for example, the feds themselves. And we computed some of our Python functions. So this computes the yield to maturity. I'm thinking if anything's wrong, it will be there. Anything obvious that comes up. What's this, for example? Yeah, this is the Newtonian calculation. Maybe it's the case that this app in question is doing it better than this Newtonian optimization method. That's very, very possible. If that's the case, then I might look into other and maybe even better optimization methods, but we'll do that later. And we've got our error, which I thought was more than enough. Okay, and we had our yields compute to maturities in series, and here I've added quite a great deal of detail and examples. Scrolling down, we're continuing. We've got all of our data, and then here this was a very interesting graph looking at the same US Treasury notes, but issued through time. So it's not actually the exact same note, but it's the same type of note in that it has the same maturity date at issue, but it has different coupons. So it was interesting to see the dynamic between the yield to maturity and the price that did not necessarily follow due to the change in coupon prices. So you can't actually compare yield to maturities when there is so many underlying changes. And that's why we're doing the bootstrapping and the spot rates in order to get these zero coupon equivalent yields as if no coupons are paid throughout. And we saw how we did this with this equation. So this is exactly the same as the one we saw before, just replacing spot rates with yield to maturities. But if we focus, let me zoom in again, just like I did last time as a very quick recap. We had a look here at how we're doing comma tau as opposed to just comma t. Comma t would just say that it is the spot rate for the bond issued at time t, but here comma tau shows us that we're actually summing. We're summing up from tau equals 1 up to this value that later on we've named capital T, a special kind of font T just to delimitate it from other types of T's. But yes, just the end of our time period, capital T. So that was an interesting concept because we saw that we could take out the last coupon payment, add it to our face value in order to get our last spot rate, which is here, right here. So now we can just ignore this and do the equation. If I scroll down, that's exactly what we've done right here. And we got our net present value, we did our equations, and we did our algebra on the right until we got our spot rates, and that was quite cool. And we did, it's quite annoying that we have to do so much algebra to come up to such a simple equation that we can just put into one single Python cell that's just this small. But at the same time, it's quite elegant. It means that we can put it into our computer and our code quite easily. All right, so we've got our spot rate, and as you can see, it says spot rate last. So we're only looking at this last one, this capital T spot rate, which is normal. You can't compute a spot rate that is intermediary, and that's an issue. That's the issue that I'm trying to both highlight and solve in this place with an example right here. With US Treasury bonds, fixed coupon rates, and a semi-annual compounding. You can change all of this, right? I mean, if you add floating coupons, which I might add to this article later and update it, they'll be quite a lot more complex. But the semi-annual compounding is not only simple to change, but also it is the norm. So I would advise going for that if you are choosing which compounding frequency to use. Don't forget that the compounding frequency for semi-annual compounding is 0.5 because it's half a year, so 0.5. If it was every year, it would be 1. All right. Scrolling down very quickly, we had our yield. What's YC? Compounded, I guess. Data frame with everything we wanted, blah, blah, blah. We had all of our data. We saw that we didn't have enough data points to get spot rates. So that's when we used not only on the run, but also off the run bonds. That was interesting. That's what we're doing right here. Fun. All right. Let me zoom out again because this is a bit much. Oh, wow. All right. And once we got both on and off the run stuff together, we saw all of this. As a matter of fact, I've just noticed that I did not run this yet. Or maybe I did, but I might have restarted my kernel. So let's run it. Run all above. And obviously, since I'm streaming my code, I'm guessing something's going to go wrong. It shouldn't. But Sod's law dictates that when you code live, there must be something wrong. And this is part of this experiment coding live, so that we can debug live as well to show you, if you're interested in not only finance, but also some coding, how the two married with each other. But no, Sod's law did not apply today, and we are looking at working code. I was actually quite interested when I read through this article again, just to recapitulate what happened in my head. I noticed here that the spot rate and the yield to maturity of the first one here is not the same. And I thought that's a bit strange. It should be the same, right? Because we're looking at zero coupon bonds. There's no difference between the two. Turns out the reason this specific spot is not the same when it should be is because the price changes. So here, if you have a look at the issue date is on the sorry, not the issue date. The redemption date is on the 1st of July. That's right. And our compounding frequency and our compounding our what is it called accrual method, our accounting method starts on the 30th or the 30th, let's say, of December 2021 or of the year, whichever year. So we're looking at the 30th of December or the 30th of June, right? And those are our periods every year that we're looking at. Whereas this one here goes for July, it goes for the 1st. What this means is that we actually have a difference in price. If we have a look here, there it is, a difference in price between the end of the year and the it's not here actually, it's annoying, and the actual price at issue. So if we have a look at when it should have been, so here for example we're looking only just at the 31st. I keep saying issue, it's actually just whichever date we're at and we're looking at. So here we're looking at specifically, we're putting ourselves in the shoes of this investor on the 31st of December 2020, but this specific bond has a yield that is calculated usually from the 31st and not the 1st. And that one day, this literally just one day, yeah, it would be one day difference is enough in price to change the yield. But if you have a look at the graph, you can't even see that change. It's so small, and I think it will be the same for the second one as well. So let's have a look. It's on the 31st. There we go. Yeah, there we go. Oh no, the 31st. And we're interested in the 31st. Does that make sense? I guess it does. Yeah, we have a difference in one day. There it is. Here it is. So we have a difference in one day of when the coupons are actually, of when the price is actually taken, and that change in price changes the yield compared to the spot rate. If the issue date is the same though, which it is. Yes, that's right. 01 price. Is that right? Yeah, that's right. Which is why we have this change in between the yield to maturity and the spot rate. As a matter of fact, here it is. Here's the spot rate, and where's the yield? So now they're the same. So that makes a bit more sense, because I was looking at this date and this date. It is still a day different, actually. So maybe it is just too small to be seen. Nonetheless, if there is such a difference, you'll have to look at the issue date and the redemption date, and to see if you are calculating your yield to maturities with respect to a day during any year that is of the exact frequency that you're looking at. So here, for example, is 6 months. So it needs to be on the 31st of either June or December. And if it's a day off, the difference between the normal yield to maturity and the spot rate, even though there shouldn't be one, could appear just simply because of this accounting frequency issue. I'm not seeing it here though. I actually think this is fine. Maybe I saw this problem, because I'm sure I did, but not for this one. So let's scroll back up. I saw this problem. 2020, there you go, 28th. And redemption 29th, and we're looking at the 31st. And where is the yield to maturity? Here it is. We have a yield to maturity and our spot rate that are different. There you go. This is probably the one I was looking at. That piqued my interest. So why is this different? Because our yield to maturity here is calculated as per the price at issue date, and the issue date was on the 28th of that month, 2020. And here we're calculating the yield to maturity on the 31st. So that change in price in that 1 day, 2 day, I think 2 days. I think it goes to the 30th on that month. Yep. The change in price means that you can see there's a change in price between this one and this one. Means that the yield changed, obviously, and so our spot rate changed. So if that happens, that's one way to have a sanity check to check if the price is different between the yield to maturity and the spot rate that you're calculating, and the yield to maturity implied by that price as well, which you can see is also different. But you can tell though it's the same, right, as the spot rate, which we expect because this is a zero coupon bond. So there is no coupons here to, and not only there's no coupons, but we're looking at a one time period. We're looking at time periods here being 6 months. So this is one time period, no coupons. So these two values, this one and this one should be the same, and they are. All right, this was a very quick interlude, a quick tangent, because I thought that was quite interesting and something that you might fall into. But we can continue with what we've got. All right, so this was quite interesting, this zigzagging motion that we spoke about, that we saw before. And I do believe now that it is basically just done because of COVID. It's happened because of COVID, because this was end of July 2020. There was quite a lot of uncertainty. I'm not sure why there wouldn't be maybe just on that one day there wasn't enough trade, wasn't enough liquidity to cause a reversion of these peaks. But if we were to scroll down and pick another date, for example, this one is 2020, the end of 2020, on 31st of December. Yeah, we see something much more not convenient, but something that we expect, something expected. Not only this, but we can see that the spot rates are quite close to the yield to maturities, but they tend to diverge as time goes by. And that makes sense because the more you diverge, the more the coupons start to accumulate, and it starts to cause a difference between this zero coupon equivalent bond and your coupon paying bond. And that's quite interesting to see. However, if I zoom in, can I zoom in? Yeah, no, it's not at all where I wanted to zoom in. Let's zoom in like this instead. Yeah, all right. So if I zoom in here, you can see we've got one here, we will have one there. There you go. They're quite straight lines, which is quite nice to see. It's probably to do with the way people try to invest in these and close the spread between whichever bond we're looking at and any instruments that you can buy off those bonds. And that's going to be the next article is going to look at some instruments, specifically swaps. But here you can see there's some somewhat straight lines, but you know it diverges and then it converges towards the end. It actually comes together, and I believe that might be something to do with trade costs, because maybe the trade cost, this gap here, this spread, wasn't enough to compensate for the trade costs. But then at some point, the spread gets larger and larger and larger, and then this spread here maybe should have been quite large, but because it is large enough, it was good enough for traders to actually compensate for trade costs, and so they actually acted on it and reduced that spread as a result. So that's an interesting theory. That's something that would be interesting to look into, maybe with these other instruments, such as swaps, for example, that we could have a look into to encrane that theory. All right, so this is what we had this far. We have our graph, we have our data. By the way, if you're interested in this specifically, I just did it in between the two streams. It's just another one of the exact same thing. And I've just put together everything we've done this far into one function right here. And I've called it, let's scroll up, get DSWS spot rates from DF. So this specifically computes spot rates from a data frame. And I've done it on purpose because I thought to myself that maybe you'd have some data of your own, or maybe you're interested in maybe scenario analysis. You're interested in, but what if the price was different? And if I was to just lock everything to Datastream, you wouldn't be able to change those prices because they would come straight from Datastream. So I thought to myself, yeah, if you can make the data frame the same format yourself, but just change the price, for example, for scenario analysis, then by all means, go ahead. However, I didn't want to have to code it in every time. So at the end, right here, I used my from df function, which is right here, and I used it in this specific function where I've removed the from df. So it's just get DSWS spot rates, and then if I scroll down, there you go. Here it uses my from df function, which makes sense, so that I don't have to write it down every time. And this is it right here. So for my on and off the run data frame of data as of the end of 2020. And this is how we got this nice looking graph, this expected looking graph. All right. So what's next then on our journey with all of this? I think that we're pretty much done actually. So this is the 22nd version. Let's save this, Control S, and so I'm gonna keep a note that. So I don't know if any of you have had time to actually read the code that was on GitHub from last time, but there was a bit of work at the bottom that I've just left in there so that I didn't have to rewrite it next time. But I was interested in doing the same thing with another one of our products. So this one is Datastream, but there's another one called Refinitiv Data Platform, and we have an API for it called Refinitiv.dataplatform. And you can import it like this with as RDP to make it quite quick and simple. Here I authenticate myself. The reason I wanted to do this is because I know that there's an issue with the search, the API search for Datastream specifically, but I know that the RDP one works extremely well. It's ridiculously powerful, and I wanted to use it, and I did. I went through a bit of code, just playing around with it to be able to understand how to get my head around it, and then I tried to implement it right here. But let's remove it from this specific version, which is the 22nd version, and instead let's scroll. There. Instead, so I've just clicked on double D to delete all of these. There we go. Let's get to our risk-free rates in question. So I already wrote quite a piece on risk-free rates with zero coupon bonds, but here we're using coupon-paying bonds. So let's have a look at this. This is risk-free rates of a. So are we still looking at 5-year Treasury notes? You see, what's interesting here is that we can do the same thing we did last time. So my previous article looked at the same thing, but with zero coupon bonds. But now we've got spot rates, which are zero coupon equivalent bonds. And so, well, at least we've got yields that are equivalent. So that's really interesting. What I will say is, if you're interested in knowing about not recurring decimals, no, but compounding, straight line, yes, all right. Risk-free rates from spot rates of coupon paying bonds. Right, so we've got coupon paying bonds, we've got our spot rates, and then we get our risk-free rates from that. I'm going to say that if you are interested in all of these details right here, you can read the previous article, which was part 1. If I scroll up, it should be somewhere in there. Risk rates, there. I'm just going to copy the link in there. All right. Let's do that. If you are interested in. So I'm going to say, no, wrong one. If you're interested in compounding, straight line arithmetic interests, geometric interests, compounding, comma, straight lines forward slash arithmetic forward slash geometric interests. Is interest good enough? I think the word is accrual, isn't it? Because you're accruing. So yeah, don't believe that, because I actually did the calculation for accruals. I remember everything, and I really don't, as a matter of fact. That's why I code. I need a computer with me for all of these. So what is accrual? There you go. Accumulation of increase of something over time, specifically payments for benefits. And this is mostly used with compounding stuff. So let's specifically say that. We're looking at accrual. Just S, accruals. If you're interested in all of this, please look into part 1. Please read part 1. You know what? I can do better than that. We can have. So you see what I've done? Oh, damn it. So here I'm closing the square bracket and opening the curly one, and I'm gonna have to close the curly one. It's not curly, is it? It's just round, just normal braces. And there you go. So now I've got my link. That's the wrong one though. Please read part 1 on, and that's where we will get risk-free rates from. So let's go back to where we were. There we go, that's the one. So if I scroll down, you'll see that I've added some contents, and you can click on specific ones, and you can get a link for specifically some of those. So if you're interested in writing maybe some of your own articles spinning from this, maybe on Medium or something as such, or even you can submit them to our competition. If you're interested in this, all you have to do is go on this developers.refinitiv.com website and go on no, that's the wrong place, use cases at the top right, and then academic, and then there's details about the competition in question. But that's not what we're here to talk about. So let's go back. Let's go back indeed. There we go. And I wanted to go in here, and I was interested in the risk-free rates. So no, that's going to be the start. That's going to be this risk-free rates. There we go. Perfect. And here you see we've got this this hashtag at the end that allows us to do this. Brilliant. On risk rates. That's it. Yeah. Risk. No, I'm not going to capitalize it. Risk-free rates. Maybe I should. I don't know. Do let me know if what is your philosophy on capitalization of such terms, because it is actually a bit bonkers, not only in finance but in math as well. It's a bit generic. All right, if you're interested in all of this, you can go in there, so that like this we don't have to, fill this article up with layman stuff. But there you go. If I can delete all of this, and we can leave the equation that is of interest to us. So here we're looking at the risk-free rates, and we know that we want to have the root as per the frequency that we're looking at. So here I've said D for day, but D's really can be anything. Could be week, can be anything. But remember that yield to maturity is annualized. So if you're looking for day, I actually forget what I go 365. I think the Fed automatically does all of its computation with 365 days. Oh, there we go, I wrote it there. Because 1, 3, and 6 months use this, and you can have these references right here, and that's quite interesting. So let's do that. So if you're interested in compounding all of these things, please read the first article. All right. Risk-free rates can be computed with the below from 0 coupon bonds. We can therefore now, what can we do now? We can use spot rates. Now use coupon paying bonds spot rates to calculate risk-free rates. All right, we can use them to calculate risk-free rates with the below. Boom. We have our equation in question, which, by the way, I've stolen from the previous article. That's why I've deleted so many things. I don't want to repeat myself too much. So I've got my RF for risk-free. We've got D, which is so I need to explain what all of these things are. Risk-free rates, in case you, maybe I mentioned it before, but you might have forgotten. This is LaTeX code, or also known as Markdown code. So here I've got my risk-free rate, where D. So when I put things in dollars, it converts it into a mathematical font, and that's how I can do these crazy things with the square roots and things and such. So where D is the frequency of daily risk-free rates of compounding. Surely it is. The compounding, yes, of compounding is the compounding frequency. Which is compounding frequency. And we have to change things, don't we? So here D is the compounding frequency, so D for day, for example. I'm not sure how risk-free rates, well, no, I am actually, but it depends completely on what you want to do with it. So for example, I used risk-free rates in the past with daily compounding frequency. Reason being, I was putting myself in the shoes at the time of a trader that traded daily. So if you're interested in that, I wrote it in R as opposed to Python, and that's information demand and stock predictability. That's an article that you can just Google and it'll come up. But here, so I was looking at daily stuff. You can look at monthly or anything as such. Here, however, we're not using yield to maturities anymore. We're using spot rates. And we're not looking specifically at that bond, are we? We're looking at just a bond. And we've changed the notation, if you remember. Instead of having comma T, which is what we did with the zero coupon bonds, when we stuck with zero coupon bonds, here we're doing underscore T. And the reason for this is we're looking at bonds that could be issued at different times. And often we are, because we need to convert these off and on the run bonds in order to get these spot rates. So this is interesting. But however, we still have to keep track of what time period we're doing this for. So comma T, because we're looking at the risk-free rates. Oh yeah, how am I going to do this? We'll find out later. Comma T. Okay, and then -1 because we're converting from a compounding rate, which would be, for example, 1.1, and we're looking at just the profit from that, which is the 0.1, so -1. And D is the only thing we did not talk about until now. Beautiful. All right, so we've got this. Because the ultimate maturity are annualized, we will have to use 365. Simple because the ultimate maturity are annualized. That's all right. That's obvious. We can use 30-day, blah 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 blah, as said by this. Okay, cool. It's simple because the ultimate maturities are annualized, and therefore, and thus are spot rates, kind of by definition, because we've computed spot rates, kind of extrapolating from these yield to maturities in this long-winded way that we've done it with bootstrapping. So if we have an example of our bond, let's say, oh, should I keep, no, let's not keep it the same. Let's make it realistic. What did we have? What is the last rate that we had? Spot rate. Here it is. All right, so let's use that one. Actually, let's be even more specific. What is this? This is the data frame of on and off the run bond data for bonds for an investor on that specific day, on the last day of 2020. So if I was to have a look at this, it's going to give me the data frame, but I specifically want the last cell. So here, this at the bottom right is the very last cell of our data frame, and I wonder if I can use iloc. So iloc, by just very quickly, you can do something like this, 0, 0, and it's going to give you the zeroth element. Which is nothing. So I want from 0 to 1, let's say, and it's going to give it to me. There you go, from 0 to 1. This is the 1th row. But if I do, I should be able to do something like this, and it will give me there you go, the specific element itself. But I'm looking for the last one. So 0, as per everything in Python, tends to be the first because it's 0 index. But let's instead do -1, which is the last usually. Alrighty, is that right? 0.006542, 0.00654, and then this is more precise. You see, this is why I wanted to do this. So let's take this and let's use it here. All right, so what is that? This is 0.0 blah blah blah. So let's say we're using this, which is approximately that. So what are we using exactly? We're using the spot rate of which bond? Which bond are we using here? It's the last one, and this bond in question is so it's a U.S. Treasury note. What is its 7 years? 7 years to maturity, which means it's a Treasury bond. I know that it's really confusing, and I speak about this in writing in the first article about how the lingo is a bit confusing. So a bond is a debt, a sovereign bond is a sovereign debt, but if a US debt is issued with yield to maturities that are higher than 10, they're called bonds, which is very confusing because they're all bonds. I've actually written this down up there. There you go. Blah, 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 blah. Treasury bonds, aka T bonds, have a maturity of 10 10 to 30 years. So we're not there yet. I haven't looked at them this long, which is quite good actually, because it means I'm not going to have to get confused with the lingo. However, just to make it clear, if it was to come up later, if we are talking about specifically these bonds, I'm always going to call them T-bonds, because they're treasury bonds. They're technically all treasury bonds, but specifically the lingo for this is T-bonds or treasury bonds for these specific yield to maturities at issue. So these the ones that go up to 7 years, for example, that's the one we're looking at. They are called treasury notes, so T notes. So let's just call them notes. Let's go back down to where we were to talk about our notes. So here, what do we have? We have a 7 year, so SY for 7 year treasury note. They got TN for treasury note. But remember that we are doing it with a specific time of issue. And when is the time of issue for this one specifically? The reason for this, the reason we're doing this, is so that we do not get confused between any two bonds, because it's very easy to get confused between bonds issue, yeah, that's the right one. And we want to make sure that if anyone else was to read our article, they would be able to not only understand what we're doing, but recreate it if they wanted to. So here it is. So this is the issue date, and we're looking at this specific scenario with a price that comes at another date, and that other date in question, is the same as the issue. Did I find a bond? I did, didn't I? I found a bond. Yes, that was issued on the correct day and matures on the correct day. As you can see here, I've searched for quite a few bonds to try and find the correct ones, because as I said, the search API for Datastream is being repaired in the backend, so I did it manually. And I forgot that I actually found one that's correct. But if you look at the one above, so for example, for just Pete's sake, just to have a look at another one. Right here, we've got one that is issued on another day. It's issued 6 months earlier. And that makes sense because I'm looking for one, if you look here, that is issued, that matures 6.5 years after this arbitrary date for our scenario analysis. And so it'll have to be either a bond that matures after 6.5 years, which don't exist issued from the Treasury, or one that was issued 6 months before the 7-year one. And that's exactly what I've done here. I found one that was issued 6 months before, because like this, it matures 6 months before to get the perfect kind of intervals that we're looking for to make exactly this kind of graph right there. All right, so we've got all of this. So thankfully, it was issued on the same day that we collected price. There's no way for me to check this on this table. I just wanted to have a quick sanity check, but there's no way to do it right there. So this is actually correct. Issued on that date. This is a spot rate calculated on that date. And what was the amount? This was the amount. Therefore, the risk-free rate will be the 365th root of all of this, which is to say that right there, -1, which is approximately, what is it? Let's have a look. So if we were to do the same thing, so here you see is the calculation from the zero coupon bond code from the previous article that I've stolen from myself. And then I can paste it here. Oh, no, go away. And that should work. It did. Ooh, interesting. Now, why would that be? Was the price higher than 100? It was sold at a discount. No, it wasn't. So what have we got here? We've got, oh, yes, where's the 1 plus? Did I remove it by accident? No, I did not remove it by accident, but there was a 1 just in the front. So let's just do that to keep the math the same, both in Markdown, which is this thing right here, and in the code. And then, so yeah, it was always going to be negative as a result, because you're removing the 1 to it. Okay, let's copy this, paste it here. So it's approximately equal to this, which in itself is approximately equal to 0.98. And it makes sense as well, because the previous one we were looking at was 1 month, and 1 month spreads tend to be ridiculously thin, so you can see there's 0.00063, whereas here it's 0.9. No, that can't be right for the daily compound risk-free rate. That makes no sense. What are we looking at here? Oh, it's done there. There you go. So you see, it's quite interesting. What happened here? What went wrong? Well, what went wrong? What went wrong? Blah blah blah. What went wrong is that here we've got the 365th root of the spot rate, and without the +1. So if I do this, it's going to take the +1 into account, but obviously I've added a random end of bracket in the middle, so I'm just going to have to add it at the front. So now this is my 1 plus to the power of my. So if you don't know about this in mathematics, if you do to the power of 1 over 2, it's the same as doing the square root. And if you do to the power of 1 over 365, it's the same as doing the 365th root. Okay, let's run this. That makes an awful lot more sense. Yes, it should be something very, very tiny, because we're looking at daily compounding interest. So imagine you're reinvesting every day, which no one does. Well, I mean, I guess actually some do, but we're not looking into something quite this intense normally. Okay, so here we have times 10 to the minus 5, which is here we've got 4 zeros at the front. Yes, that's right. And so what does that mean? It means we've got approximately 1, 2, 3, 0.02. Well, let's do the same number of significant figures. So 1, 2, 3, 4, 5. We've got 5 here. So sorry, so if we divide by 100, it will be there. So 1, 2, 3, 4, 5. The next one is 6, so we're going to have to increase it by 1, so that's 9. And that's what we've got right here. Delete this, run those two. Boom. All right. So here what we've done, we've applied our risk-free rate calculation to the data that we had from previously above. And we were looking at this 7-year Treasury note issued and calculated on the same day at the end of 2020 to get a spot rate that was this much. And from this spot rate, we get a daily risk-free rate that is just that. Boom, boom, boom. Bish, bash, bosh. We've got our risk-free rate. Let's leave that here because it has quite a lot of very interesting links that gets to the Fed and interesting stuff in there about how you can figure out the kind of time periods that they go for. So 6 months, 1 month, 1 month always being 30 days, for example. These things are extremely important. There is actually a case, I forgot which country, an island country, where it was very political. They were issuing some bonds, and they said it was going to last a month, and did not define what a month was, and it went awry very quickly. Actually, I think that the government was scrapped because of it. It's kind of a fiscal cliff that you hear of in the US, but obviously in the US they've defined these things previously, and it tends to be political only a political issue from which you get these fiscal cliffs. Nonetheless, another tangent to talk about the importance of the definitions right here. So I'm going to leave that here. Maybe I'm going to remove that. So what's this reference? Because the first reference that we saw, this one was just a federal rate, and the federal rates are explicitly not the ones we're looking at. And I'm doing this on purpose because federal rates, they're pretty much impossible to get for you and me, for Lambda traders. So yeah, I'm going to leave this one. I'm going to keep this one. Reason being, there is here in the footnotes the explanation of their time periods. So let's do that. I believe it's the second one. It's not the first one. Yeah. See more here. Boom, boom. Boom. And we don't need to talk about that. All right. So this is actually quite simple. This is why I was kind of afraid, there wasn't going to be too much to talk about today. I was hoping maybe some questions on the chat or things as such, but I can see that normally it tends to be the recording that has a larger viewership. So if you do have any questions, on YouTube, put it on the comments, or even here on the stream, put it on the chat. Alrighty. So we're not going to have to, I think I've already got cufflinks. Let's check. We're not going to have to import all of this again. Yeah. Yeah. Pretty sure we don't need any of this whatsoever. Let's remove that. Now, what's interesting is we don't have to create a new function since we are using the spot rates. We can use the old one. We can do just that. Ultimately implied by all of this. Let me check that this is the correct function. So if I go up there for my source code, by the way, there is source code with all of our articles. So I'm just going to have a look at mine. Hopefully it's going to load. Sometimes it's very capricious on GitHub. Version 12. Oh yeah, this was the previous one. This is version 14. And here this is version 21 and 15. Oh, okay, yeah, 14 and 15 are going to be really close. So I'm going to leave this one just because it's in the previous video, but I'm going to use this one right now. Let's have a look at the defined function for the risk-free rates. Oh yes, it loaded. If I scroll down, here it is. See, I don't actually need to. The reason I need to scroll down is because it's loading some of the LaTeX code. I don't need to change any of this because we're using spot rates, and spot rates are zero coupon equivalent. So much so that I'm not even going to define it. Yep, let's do that. All right, so scroll back up. If it allows me. There you go. Beautiful. Here we had our part one. There we go. Now we can say that using using the defined function, and then I'm going to put the name of the function there. From part one. Part one. Nope. For some reason it did not like that. There you go. Control C. Control V. It's it's just being silly. There you go. Right. From part one, we can easily compute risk-free rates. What's the function again? Let's have a look. Zero coupon bond, yield to maturity implied, risk-free rate. That's quite a specific name, is there? Yes, there we go, value implied. I don't like that one. I was thinking of removing it, but I thought to myself, well, there is actually a use for it, so why not just leave it? So if I scroll back up, that's the one. Unfortunately, I don't remember how to do reverse inverted commas, which is what you need in LaTeX code to get a special font, and that's the one I want right now. You'll see why. But I've already used it in this code, so that's why I'm scrolling up, just checking what I've written. There you go, here it is. So you see how it's highlighted as if it's code. That's kind of cool. I like that. And I don't have like a key for it, so I just have to keep it in my code and copy and paste it. I'm sure I could just have like a reference Word file. That's how people normally go by doing this when they're using languages with accents with an English keyboard, but too much effort. All right, so we've got, let's use that function, shall we? I'm gonna have to define it because it's in the code. Oh well, let's define it anyway. Boom. It's probably the same as the one we had before. Let's just check that that's the case. Scroll, scroll, scroll. Yeah, no, it's not the same. I think I've tried to change it. Yield to implied risk-free rates. What did I change about it? Just bond. Yeah. I thought that when I started this, I thought that there might be a difference, but there isn't. So let's just copy and paste it. Defined function. Take it all. Yeah, this is very much the tail end of this article being written, which is quite good, I guess, because then I can just go back through all of it. And if you have any questions, put in comments in the chat, and I can go through it. But this is what we have for zero coupon bond, yield to maturity, implied risk-free rate, bish bash bosh. However, oh no, I thought this was going to take the risk-free rates from from Datastream, but it doesn't. It's just telling you this is one of the ways to do it. Now, what's interesting is that it's going to take, if you look at the code, right, it's saying, oh, it's renaming the columns. There you go, correctly. This is gonna be tricky. Let's make sure. That's a bit tricky. Maybe I should actually make a function that will do it just once. So I'll make a function which will give you a floating point number, as opposed to just a whole data frame. And a whole data frame is fine. Matter of fact, I'm going to keep this code and I'm going to just tweak it to make it work with that. But it's a bit complicated. It's a bit convoluted. Risk-free rate. Yeah, and the other one I'm going to call df, and I'm going to update it. That's what I'm going to do. I'm going to update it. Df. All right, so we have our yield to maturity, which used to be a data frame here, but this is going to be a float. And d, which was our period. So this doesn't change much, actually. Let's copy and paste that. Up. Yield to maturity is not going to be a data frame, though. It's going to be a floating point number. Float. And also, I think I've changed the way in which I do this. So you see, I've changed the way in which I write these things. So what are the dependencies? And we have our variable name following by this, and then it's indented. So let's do that, shall we? Boom, boom, boom. So what dependencies have we got here, if any? Pandas. And that's it. Probably, yeah. Looks like it's just pandas. Beautiful. Pandas, remove that. What parameters have we got? So this is actually quite good. It's showing you how one goes about writing what is called doc strings. So doc strings is just documentation, but just in string form. There's no fancy formatting or anything that such done. Instead, it's just straightforward writing, just letters and characters. Let me just figure out my T. I know that I am French and I have somewhat of a French accent, but I've been accustomed to T in the UK for years now. So let's get, oh yes, that's nice. There you go. Alrighty, where we at? We've got our floating point number for our yield to maturity from a zero coupon bond. Yield to maturity of a zero coupon bond. Zero coupon or equivalent bond. And then what I can do when I'm done with this is I can update the function that I did in the previous article. It requires nothing actually. And we can have an example. No, there's no need. This is just going to be a number, right? Right. Yes. Yes. It's the spot rate basically. All right, same with this. So d is going to be an integer, and what integer is it going to be? It's going to be 1 for the frequency. Number of time periods, yeah, frequency. Days. Oh, that's why I've done it. That's how I've done it. Okay. I guess it makes sense because, like, for example, the example we're given from US Fed, they do it in days specifically. So let's keep with it. And update from version, it's going to be a new one. New update. Oh, delete. Maybe a space there. Update from version 2 to 1, to 3, I mean. What have I done for this? What have we done? So this is all very good, you know, to record and to show. This is how you go about not only updating your functions. This is the way some companies, some people, such as, for example, pandas, do it. They update their functions and they put doc strings in there, such as this, to update what they've done with it. And this is version from 2 to 3. We have adapted this function to 0 coupon equivalent bonds. All right. Is that all we need to say? I think it is. 2 to 3, this Python function, blah, 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 0 coupon with an O, coupon or equivalent. If I've done some mistakes, by the way, either do tell me or I will check before I publish it. That's always what I do. All right, boom, 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 bish, bash, bosh, and we are good. Good to go for this. All right, so what we've got here is our function that we're creating, and we are doing something very similar to what I've done here. So calculating our risk-free rate, all right, which is the easiest bit, really. It might seem silly to do this, but it's quite essential. So we've got a risk-free rate, and then what are we doing to it? I'm kind of realizing why I did all this is because the risk-free rate calculation itself is actually dead simple. It's not like the other times when it was quite long, like the spot rates. This isn't useless though, because I can at least copy and paste it if I want to do it in a data frame format, which I think I will anyway. I'll do this anyway. It is dead simple. All right. There's no need for any of this really. We're just returning it. Return this. And so we've adapted it to the 0 coupon equivalent bonds and returned only a float. Yeah, that's what we did. Saved. And now that we've done this, we can get the df, which is going to be the exact same thing. Oh no, there's no return. So in the doc string, it's always quite important to have a return. There you go, returns. Reason being, you know, you want to know what does it return? What's the point in this function? So let's put that there. Oh, no, for that. You don't need any like empty spaces, empty gaps, because it's still taken in by the code. It's still there, which means it takes some memory. If you've got a space, it's actually, I think it is a byte. Yes, it would be. Yeah. You don't want to waste that memory for no reason. So it returns a float. All right. Easy peasy. That's what we've got, and this is the data frame, which is the same. So this is going to be version 1 actually, since the previous one was not called. Underscore df at the end. 0 coupon, same mistake, or equivalent bond. with, if I am not incorrect, the same parameters, the same dependencies, but just a different return. So just copy and paste this. By the way, if you're interested in why I'm doing all these doc strings and how this is actually useful when you start to code, I'll show you just when I'm done with this. So underscore df, boom. This is what we've got. Bish bash bosh, our yield to maturity. So it does not you don't want to put in a float. You want to put in a pandas data frame. Let's go back to the start. Pandas is either a company or like a, I don't know, institution of some kind. So let's capitalize it. And D is going to be an integer. Yeah. And it returns a pandas data frame. All right. So now we've got our data frame instrument name. Does that matter? Let's have a look at what we're trying to do here. We have our spot rates here. Oh, we don't really want a data frame, actually. We want a list. We just want a simple array. Data frame is kind of overkilling it. Yeah. So the previous one was just, the previous function actually was fine, and it was working with a very specific way in which data stream returned data, which is very useful. Here, however, this is not what we want to do. We want it to be a bit more easy to use. So I'm actually going to, I don't want this actually. So as I said, we don't need this, but I did copy and paste quite a lot from it, so it wasn't useless. However, we want that. So we're going to leave that. We're going to delete this. Nope. So you can see how I delete cells. Just press D twice. We've got a dependency. We've got our parameters. Yes, that's fine. But we don't want it to be a pandas data frame. We want it to be just a list. List of float or integers. Yield to maturities of 0 coupon or equivalent bonds. Yes, that makes sense. Does it make sense? We're going to get our our risk-free rate from the spot rate itself, but the spot rate itself is going to change every day. Because every day you don't have the same bond that you can trade with. If we follow the same bond through time, the cash flow is going to become quite complicated. So either you follow the same bond through time. So let's say you hold on to the bond you're buying until its maturity, which is fine. Then the calculation is quite complex. Or you look for a new bond every day. Liquidity is definitely going to be an issue there. That's not very useful. So what does one do in that situation? Because before, what were we doing? We were just looking at the rates. The rates were given by the Fed. So that was very simple. Was it daily? Surely it wasn't daily. Let's have a look. It was. Yep. Well, every trading or every working day. So if that's the case, see, how do we put this into a Python code? We would have to look into a person who holds the bond. Okay, so this is becoming very interesting. Very interesting indeed. I don't think we can reuse this. Well, at least the only thing we can reuse is that right here, which is fine. Quite a lot of work went into that. I'm wondering, however, if that is quite big, maybe an article in and of itself. Let's think about this. We would be looking at an investor who every day makes a decision, and his or her decision is either I buy a risky asset, let's say a stock, or I buy this kind of a riskless or very, very close to risk-free asset with a specific risk-free rate. The yield to maturity is annualized. However, if I was to compare my revenue from my trading strategy every day, I'd have to look at the daily compound interest of my position. Aha, no. We won't have to look at the we would not have to look at the price every day, because what this implies is an investor who, let's say, buys this risk-free rate and keeps it till maturity. If you do that, then you get this very specific risk-free rate. It's actually quite simple. So if you were to hold it, it ends up to this. The idea, however, is, what if you do not hold it? What if you sell it? So you buy it from one day and sell it at the end. So is that the idea? Is that what we're going with? Technically, no. Technically, you'd have someone who buys a bond and then keeps it. To be even more technical, if you are hedging bets like this, if you're hedging trades like that, then maybe you'd be buying a bond and keeping it anyway, to first of all reduce trade costs and also hold a hedge for another trade you may have doing something else. Especially if you do very, very many trades, then it's actually quite it's not that difficult to hold. Oh, this is a tough one. This is when more viewers giving me live comments would be better. I don't know which one to choose. And if I do both, that would be quite an article. So the first choice is putting ourselves in the shoes of someone who does everything that we've just said and keeps the bond till maturity. And we're looking at stuff that matures in 7 years' time. So either they do that, or they sell after whatever the D is. So if it's a day, if it's a week, buy at the start of the week, sell it at the end of the week. I think that's a lot better. However, liquidity was an issue to start with, and now it's going to be just, well, if I'm not actually trading it, it's going to be very, very long and tedious. Not to mention the liquidity. Let's have a look. You know what? Let's investigate. The liquidity issue for this is going to be quite unsurmountable. Definitely can't do it for days. Let's try and do it for weeks. So what is this? This is the end of 2020, 31. So let's try and do either the 6th or the 7th of January 2021. What is that we're looking for then? Let's have a look. Boom. So we're looking for that. It will be issued in 2021. Yes, that's right. Yes, and we're looking for maybe 1 year bond. You know what? Maybe not. Maybe we're looking at. So this was 6 months, wasn't it? But now we're only just looking at a week later. So let's do 7th. Surely that's right. Yes. Yeah, we're definitely going to have liquidity issues. Let's try just around that date. So why is there one that exists on the 6th but not on the 7th? Probably because it was not a trading day. See, we end up with such technicalities when it comes to liquidity with this. So what day is that? July. July 6th. Yep. Oh no, 7th is a Tuesday. There just wasn't one. There's just no data for this specific one. Yeah, this is becoming too large for an article, because every single time what one would have to do is look for a off the run bond that matures specifically on the 7th, for example. So what we should do is just one example, I guess. This is complicated, isn't it? How does one, what one needs to do is search and find automatically those bonds. And that's when the search API comes in, and that's what's broken right now. And as a result, what we'll do, yes, that's it. We will just have a very quick calculation for the risk-free rate and the excess return, which is fine. And we'll leave it as floating point numbers as opposed to either lists or data frames. Then I'll try and make it work with the RDP search engine API, which is extremely powerful, and I know that works right now. Yes, that's right. And then we'll have a look at this whilst the backend is being repaired for Datastream. And then once that's repaired, we'll update this part 2 article into coupon paying bonds with Datastream. Yes, let's do that. All right. In that case, what we're doing here is deleting that. If you're interested in the compounding, blah, 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 we're looking at this equation. For example, we've got that. Yes, that is. We're still doing this, aren't we? We're using the previous function from part 1. Using the defined function, blah, 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 we can easily compute risk-free rates as per the Python code. I can't run it though, so I'll just have to put it here in those reverse inverted commas. Boom, boom, boom. Easy peasy. And then scroll down, scroll down, scroll down, scroll down, 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 down. And this is just a note that I've written a while back. Right, delete this. Save this, and these are the references. Right. Now let's have a look at. So I pressed C, by the way, on the cell, and V to paste it, C to copy, V to paste, D to delete. So now we're not looking at risk-free rates, but excess returns from spot rates. Beautiful. Right. So what were we looking at before? Before we were looking at, scroll down, that's just risk-free rates, returns. Now we know that. Now that we know the risk-free rate, we can get the return, which is this, which is that. For example, let's use the S&P 500. Yes, let's do that again. That's a pretty good way to do it. So I've already got my code for the LaTeX code for the risk-free rate article. So let's not reinvent the wheel. Let's find it. Zero coupon bonds, coding. There it is. Create a function for a risk-free rate. Excess returns. Now we know the risk-free rates, it's easy to find out the excess return at time t from price p. Now we can get a vector. All of this is still applicable. Perfect. You see, let's not. First of all, let's not reinvent the wheel. So let's copy and paste. But second of all, this was already written in the previous article, so we're not going to expand on it. We're not even going to write as much about it. So let's just do v here. Excess returns from this. Yeah, but this is still applicable. So let's just do that. Let's remove this. Yeah. There's no need to put it in different cells. I don't know why I did this. It just makes it a bit more difficult and unwieldy. Okay, so we have our, is everything here still applicable? Yes, we got the price, we got the risk-free rate. Oh, I've done an underscore T, which makes sense. Up to T, where T is there, R is thus defined as the cell below. R, not R. Excess R, excess return. I'm hoping that error is not. There is no math R, is there? Unless there is. Let's try it in there. That must be it. Pretty sure. Excess returns. Is this defined as the below? Alrighty. Boom. So what have we got here? We've got our price of our SPX, which actually is the same as last time. So let's keep it there. The risk-free rate. But we only need the one specific one. So here we're looking at this investor on that day. What's the day again? The day is the last day of 2020. And the risk-free rate is going to be this. So what's our yield to maturity here? Our yield to maturity is going to be this again. So just to make sure that that's understandable, we can write, remember that this is our spot rate. We've got all of this, and then it's to the power of D. D here is going to be 365. We're looking at daily stuff. We don't need anything about columns. We don't care about any of that. I think all we care about is, there you go, here it is. Price minus the shift, yeah, because that's the return, isn't it? Okay, let's have a quick look at what this is first. So if we do this, oh, by the way, the way I split the cell is with, what was it again? Control Shift, is it? Control Shift minus? Yes, it is. Control Shift minus. So let's run these two. Oh, yeah. It's because I asked for it from 1950. But I only want one. There's no need to call for more data than we need. There you go. And I just want the value. So I think if I do ilock again, -1, comma, -1. Let's try that. Beautiful. So we've got our price. I'm going to need the change though, and the change in price, so the return today is the change from yesterday. So we're going to need not just the 31st, but the 30th. That's still going to be the same, obviously. So let's just have a quick look at our data frame. Hopefully there's going to be two of them. Yeah, I say hopefully because it could. Normally they're not trading days, so I don't know why there's data there, and it's different data as well. So it's definitely been trading. Yeah, I guess over the counter. Okay, so we've got our last one. How are we going to capture? So this one is the last one, right? How are we going to capture this one? Because I don't think it's going to be 0. Maybe it is. Maybe it isn't. It is. Beautiful. So the 0 is this one. The 1 is this one. Although I don't like to use ilock because it makes it a bit confusing. What are we looking at? So at least P underscore SPX, clearly shows that we're looking at the S&P 500 price. So I don't need to show anything about that. Let's try instead and use lock. So lock is another one you can use as opposed to ilock. And I believe this should work, although I'm not. Yes, but we want the value. So dot value. Oh, now it's becoming a bit confusing, isn't it? If I do this, before it was a bit simple. No, it's not looking at all. Values, I think with an S. Yeah, and then if I do this, it's a bit much, isn't it? Just for one, as opposed to the ilock. I think ilock is just too neat compared to this to excuse such an ugly code. All right, so we've got our two prices. So we're going to do the difference between the two right here. So what is going to be today's price. Yeah, that's what I'm doing right now. Today's price minus yesterday's price. That's going to return divided by yesterday's price, surely, because we're looking at increase in percentage terms. Yeah, that's right. Minus RF, and RF is going to be computed right there. we're looking at the difference in price between one day and the other, and we're using the risk-free rate on daily frequency. So the two are of correct and similar frequencies, which is good. I can delete all of that. And that's all that we need. Since there's so little code here, let's just put it all together. Don't need that, don't need that, don't need that, don't need that. Now there's a question here. Why am I using the spot rate, that last spot rate, as opposed to another one? You can use any, right? Yeah, it's quite simple. But we should explicitly say that out loud. So here the example is S&P 500 with index. With the, what are we using here? We're using the 7-year. Where's the 7-year Treasury note? That's right. Issued. Let's just make sure that it's quite clear. Issued on 2020 12/31. So that's what we're using. Using the 7-year one, issued on that day, matures naturally 7 years later. All right, let's run this. Beautiful. So this is our excess return. So now what we're seeing is that if an investor on the 30th of December was to choose between investing in the S&P 500 and this bond provided by the Fed, then the S&P 500 would have provided a return higher than this risk-free rate, this bond, by this much in absolute terms. So if you invest $1, it's going to give you 0.006 cents, or dollars actually. So 0.64 cents. So that's quite interesting. And that's obviously why you don't invest just $1. You go for quite a lot more. That's quite a lot. Well, that's quite low actually. Well, no, obviously not, because we're looking at daily. Daily, actually, that's extremely high for daily, especially since no one really. I don't know of anyone that would reinvest, because that means if you're reinvesting every day, so if you're compounding if you're accruing your returns every day, that means that you have to just buy it on one day and resell it as well, either on the same day or at the open of the next day. Or here specifically, it's going to be you sell it at the end of one day and you buy it at the end. So it's quite a difficult way to make money here. So I don't know anyone that does it per day, but you don't have to make it per day. So here you see you can make it a week earlier, and this could be, I think it's 52 weeks a year, and this would be the same. So here is our excess return on a daily basis. The only reason you'd use daily basis is for backtesting of methods, trying to put yourself in the shoes of an investor that on one day is making one choice, and that's when it gets interesting. Okay. So this is the note about the copious amount of work that needs to be done in order to find those bonds. So when I said that we found the bonds that matures at the right time, you need to do that manually at the moment because of the Datastream search API that's just not functioning right now. And that's what you did. Well, that's what I did, and you can see the number of bonds I had to search for. And I created this table to look and to verify which bonds matures when, and which one will be useful for our investigation. All right, I think I'm going to stop here because there isn't much else to do. All I need to do is rewrite all of this to make sure that it's first of all without any spelling mistakes and things as such. Make sure it makes sense to have a conclusion. What was the conclusion before? Let's have a quick look. Yeah, very simply, just you can do excess rates with coupon paying bonds this time, and then spot rates. And then what I'm going to do is have a quick look at RDP for next time. So let's say I think I can leave this to next week, same time, same day, so Tuesday at 4 p.m. British summertime, and on Twitch, and I'm going to post it on YouTube when it's done. And I'm going to do the same thing, but with RDP using the RDP search API, which is quite useful and will probably even maybe. That's an interesting one, because I know I can use both Datastream and Icon together, right, or an RDP together. So maybe, depending on how well that works, I'll be able to get the mnemonic on Datastream using RDP and mix the two in order to get a list or a data frame of excess returns or risk-free rates at any period that you want. So here we looked at daily, not period, frequency, any frequency that you want. This is daily frequency, but it would be really cool to have a function that does it for you. Yeah, so that's what I'm going to look at in between today and Tuesday, and hopefully I'll have something there for you. Yes, and I'll say, caveat, if you have RDP, you can do this technique, and then there's going to be a function at the end of it. That would be quite cool. And that will be the last thing. And if that's not possible, next week we're just going to switch straight away to part 3. Part 3 is going to be looking at exactly the same thing, but instead of so here what we did is bootstrapping spot rates from coupon paying bonds, and specifically just the bonds, and we looked at nothing else but bond data from the secondary market. This time we're going to look at our instruments such as swaps, and we're going to see how we can extrapolate bond prices from swaps. And then what I'm going to try and graph a spread between the price of a bond implied by an instrument such as a swap and the actual price of that bond. And you can see that the difference between the two is the spread, and that's when investors can start to try and find some arbitrage to exploit. And this is why you shouldn't see such a huge spread between bonds that mature quite close to each other, or maybe even at the same time, given by different issuers. So the spreads should be quite low, especially maybe now. Maybe they were a bit higher during COVID because there was a lot of uncertainty. So higher volatility would mean higher amounts of opportunities, which in itself means higher spreads. Also, you can have a look at the spreads, not only in those terms, but in terms of a spread between one country and the other. And maybe it's very, as we've seen today, the liquidity of these bonds, of these debts, are quite low, and so it's quite difficult to trade them. However, these other instruments that I'm talking about, such as swaps, are over the counter, and you can buy them and sell them kind of at will, and they're a lot more liquid. And this is how you can find spreads a lot better. So we'll look into this next time if there isn't a clever use of Refinitiv Data Platform API that we can use right here to get some more insight on the data that we've already got. Alrighty, well, I hope to see you next week. Don't hesitate if you have any questions to either comment below, or if you're interested, you can also go on our we've got a question page, Q&A page for developers on community.developers.refinitiv.com, and in there you can ask any questions related to our APIs and to our articles. So if you're interested in specifically the zero coupon bond article or the coupon paying bond article, once it's put out there, don't hesitate to go in there as well if you've got any questions. All right, I hope to see you next week.